All right, welcome back to the Financial Shepherd Happy Hour. We're here on Friday in studio down at Pensive Distillery. Welcome to the show. We're glad you're all here. Friday is happy hour, as you know. We're here to recap the week, have a little fun, get your favorite beverage or seltzer or a cup of water or tea, whatever your flavor is on a Friday afternoon after your work week. But we got some really cool stuff to kind of share with you all as far as what happened this week, why did it happen, what can we look forward to next week. So that's kind of the purpose of the show. That's the agenda today. Happy to jump into that. Ez, anything on your plate this Friday?
No, it's definitely a happy hour this Friday with the little rally we've experienced. I know today was, kind of a little whimper towards it, but definitely got something to cheers rather than to squash down.
Absolutely. We've had a really good run here in this. We're not for sure if we're going to call it a bear market rally or just the recovery from the lows that we saw in June earlier this year. But this week was more of a pullback kind of week, not in a dramatic fashion. S&P 500 was down just under 1% for the week. NASDAQ was down the most at 2.24% for the week, but also had the biggest recovery, of course, because it was the biggest sector that had the largest pullback so far year to date. Dow Jones was basically flat, slightly down 0.01%. Russell 2000, which is your small cap index, down 2.51%, and the bond sector saw a pretty big pullback. Interest rates went up nearly 2% over the past week, which is bad for bonds. Been a tough sector to be in all year long with rates going up around the world. But bonds for the week were down 1.3% and still down about 10% approximately year to date. So all in all, not the worst week in the world, but certainly not unexpected either, I don't think, after pretty much 4 straight weeks of up into the right type of movements for all these major indices. But we were able to do some research, obviously, leading up to today's show that we have here today. And I talked yesterday on the live podcast that we did. I don't know, it was like 50 minutes or something like that. We try to do a full-blown show once every 2 weeks. And yesterday we spent a pretty good amount of time talking about the technology sector because the S&P 500 was down, 22% at one point in time here, right around mid-June, and has clawed a lot of that back in the form of 4 straight weeks worth of positive returns. Now, the tech sector is the largest sector in the S&P 500. It is a sector that we at Shepherd Wealth Management in general for most clients are a little bit overweight. Simply put, because technology is in every sector across every industry around the world. I mean, you cannot function in this global economy without, purchasing firewall protection, without using Microsoft's, software services. I mean, we can go on and on for probably a full day talking about the tech sector and how it's fully integrated with every other sector and all the major averages, including the S&P. Again, that's the biggest weighting in the S&P 500 is technology. So we talked about that in pretty good detail yesterday.
Yeah, we did.
Today, I wanted to share a little bit more research that we were able to do leading up to today's show. So the S&P 500 tech stocks in a bear market cycle were more than 90%. So more than 90% of the companies in the S&P 500 in the tech sector were in a bear market. Over 90% of them were at one point in time this year. As of Thursday, less than half of the tech shares in the S&P 500 were in a bear market territory, again, coming out of the June lows. Now, if we look at history, and we talked how important it is to learn from history, and my favorite guy, Warren Buffett, right?
Spirit animal here at SWM.
Yeah, I talk about it all the time. It was in the last newsletter I sent out to clients, is Warren Buffett quoted saying that human beings are historically do not learn from history. So I like to look at history under similar circumstances, and here's what we found, which is the really cool part of the data to share here with everybody. So after similar reversals, the sector was higher 89% of the time a year later. So it's not guaranteed. It's not saying that that's going to be off to the races for the technology sector at all. And as I always tell all the compliance folks out there that are watching this, past performance is no guarantee of future results. However, human beings make up the market. And human beings, as Buffett famously said, tend to not learn from history. So that's why we're sharing this information with you all, because it is an opportunity to either start to participate in the sector, add to positions that have come back like we've done for clients, or just simply rebalance. Hopefully there's a portion of your portfolio, like for us, in the healthcare sector, in the defensive sector, not like defensive utilities, meaning like defensive companies that make, guns and bombs, as well as, of course, the energy sector is the only sector of the S&P 500 that has significant positive performance year to date. Rebalancing out of that into a space like technology could be a pretty good strategy based on the data that we're looking at here. Now, in the short run, looking at the history of the information I just shared with you, in the short run, meaning over the next month to 3 months, the tech sector could actually underperform the S&P 500. But if you look at it over a year later after similar events, it's a significant outperformance. And for clients that are looking for outperformance, which is why we tend to overweight a little bit of tech, again, because it affects every other industry and every other company.
Everything. And as soon as some of these external factors are alleviated, I think you're going to see a massive rally in tech.
Yeah, I mean, quite frankly, you can call it a recession, you can call it a bear market, you can call it whatever you want to call it.
It sucked, regardless of the name. It's awful.
The thing is, and you have to joke about it a little bit just to kind of keep your sanity.
Yeah,
that's
what the beer's for usually most Fridays.
I'm an investor too, so I don't like seeing that in my portfolio since I'm investing the same way that my clients are. But it is an important piece of data that I think everybody deserves to know about. That way you can begin to make informed decisions. Now, some other key kind of like macroeconomic data points I thought would be worth sharing here today. One, the US dollar is very, exceptionally strong. Now, that's a good thing if you're going on vacation to Paris or Rome or, wherever it is that you're going to go, because, the dollar is worth more than whatever their currency is at the moment, which means you can actually, stay longer or have a nicer dinner or maybe a nicer hotel room.
Gotta put in my PTO request, send that to HR.
However, when companies are shipping their goods and services or their goods, to other parts of the world, it actually hurts their profit margins because they're exchanging, let's say, yen for US dollars and getting less yen. Mm-hmm. So that is difficult and it is a major headwind for a lot of companies. So you're hearing a lot about that right now. If you're following along any major news outlet that follows, the stock market. So that's something that's notable, but will not last forever. Now, the Chinese economy, which is obviously the second largest economy, in the entire world, it's forecasted its lowest growth in 40 years. And that's significant simply not only because they're the second largest, economy in the world, but China historically has been, we're going to grow at all costs sort of scenario.
Yeah, all gas, no brakes kind of situation.
They've been calling themselves essentially China Inc. for decades, as long as I've been alive, for sure. Mm-hmm. And the last thing I thought was important to note here, because we've spent a decent amount of time over the last couple happy hours, the last couple podcasts talking about investor confidence or sentiment. The University of Michigan does a consumer sentiment survey every single month. They've been doing it since 1953. There's going to be a new survey next Friday, but there already was one in UK. So the UK consumer confidence has sunk to its lowest level in the history of them tracking that data. So why is that significant? Just like what happened here in the United States earlier in the year, February, March, obviously June seemed to be the low. We don't know that for sure yet. But consumer confidence here in the United States at the low is also at its lowest point in history. And we saw this really nice recovery over the last 4 weeks. So something that I'm talking already with clients about is we don't really have any international exposure. Now, we have companies that are doing business around the globe. So we are getting international diversification in some ways through those very large companies that sell things across the globe. But not a direct international position. Now, that's important as we go to the end of the year, whether it's tax loss harvesting, if the market continues to stay super volatile, if we just simply continue to have a lot of pullbacks in the market and a whole bunch more volatility, it does present an opportunity to add international as part of the well-diversified portfolio that we're building for clients. And you want to be able to do that simply when everybody else does not want to participate, just like, again, I go back to Buffett and his track record of outperforming the market, since like 1963 by 2x. He's trying to be greedy when others are fearful, right? And his investments this year, he's definitely put his money where his mouth is. Everybody else was fearful. He put over $50 billion to work. From a performance standpoint, hasn't completely worked out just yet, but his track record would suggest is probably likely going to be a really good outcome for Berkshire Hathaway shareholders as the market does recover, as we would expect that it would. My anticipation for that is going to be sometime here this fall. I've talked about that, all year long. So that's kind of the high level of what happened this week. Some important news, some really good research data that we were able to do specifically in the tech sector. And next week, we're going to get some more data from the tech sector as well as retailers and others. So you'll see Salesforce coming out with numbers. NVIDIA, really excited about that one. Chip space obviously is a very important space here for the global economy. We all know how important chips are after the global pandemic. And we also passed a CHIPS Act, and we talked about that the other day on the big podcast show. So I'm looking forward to more earnings announcements next week. We got the University of Michigan Consumer Confidence survey coming out on Friday, so I'm interested to see that. Hopefully, it's moving upward and not downward. But if it is moving downward again,
oh man, those last two in the low 50s.
it's just an opportunity for us to potentially rebalance and acquire positions.
Right. I see it as an opportunity to alleviate myself of my own liquidity.
So any way you want to look at it, it's been a really good last couple of weeks here. Although this week in and of itself wasn't a bright spot from a performance standpoint, but the technical indicators, the fundamentals, the fact that 80% of companies that have reported so far have either met or exceeded analyst expectations, a very strong labor market. I know we have some headwinds with supply chain, with Fed decisions that are coming up.
When's the next one coming?
Fed decision. So they're doing Jackson Hole next week, which is a big meeting of a whole bunch of really smart, wealthy people going to try to figure out how they're going to make decisions with their company, as well as what the Fed's going to do with interest rates. And then the Fed will come out and make their announcement in September after we get the next inflation reading. So we can look forward to that over the coming weeks as well, which may not get as much of attention because in September, of course, we're kicking off football season. So everybody knows here in the United States, that's kind of like the the one thing that we're not going to miss on the Saturday.
Also election season, which, oh man, I cannot wait for the onslaught of those ads.
Yeah, that's coming on future happy hours and podcasts, no doubt about it. I have plenty of data to share on that one. It's a conversation I've had with all clients, as long as I've been in the industry for about 10 years now. Everybody has that question of, what's going to happen in the market if so-and-so wins or who takes over Congress or the Senate or what have you. So there's plenty of data coming there. Don't worry, I got you all covered. But it's been a great happy hour. Hope you all have a wonderful weekend. Grab your favorite beverage of choice and stay safe out there. Hope you all have a great rest of your weekend. Take care.
Stay safe, y'all.